So just get a little bit of a sense for the crowd here. Most of you have startups. Yes, no, most, yes, okay. Any investors out in the crowd? Okay. All right, used to be, good. And then most of you have formed your company already? Okay. Some are still considering formation issues, C Corp, LLC, et cetera. I say that only because there's another presentation I do a lot of times at some of the accelerators in town, right, where folks come in, and that's still a relevant question, divvying up equity, you know, whether to vest, not to vest, et cetera. Separate presentation, but I do a lot of startup work. So I've been doing startup work out here. I think I came out to Silicon Valley in '99. Been through a couple of the downturns, so a lot of startups, a lot of venture-backed companies. I represent some venture funds. I represent some corporate VCs, which is something I'll touch on. That's really been pretty fascinating over the last couple of years as corporate has kind of piled back in to not just late stage, but actually some early stage investing as well. And I do a lot of mergers and acquisitions work to subsidize my startup habit. For any of you who provide services to startups, you know that you can't make a living off of just working with startups. But now you guys grow and become terrific companies, and I have some terrific companies that I've been with since the earliest days. All right, so I was going to hit this really quickly. I'm not going to spend too much time. Sometimes I might, but given, again, the duration of tonight, this is stuff you can look up. I'll tell you two places where I found this, but it helps frame the discussion. You can go to the NVCA website, nvca.org, and the other was PitchBook. PitchBook, it's a service, it's a paid service, but you can actually download some of the reports for free if you give them your email. So startup financing trends. I just looked over this stuff this morning for Q2 that had come in. So look, lots of deals are still happening. I'm seeing that in my own practice. I gave a presentation in early January, right down the road here at Silicon Valley Bank, to a bunch of their customers, their clients, and sort of my theme was like brace, right? Because I've seen this twice, and it's not pretty, and it's coming. And I was waiting, kept doing deals, and now we're almost into August, and I've continued to do deals. A lot of my companies, early stage, have gotten funded. I've had companies that were at seed actually close Series A financings for them, which was sort of one area where I was expecting was going to get really hit. Still doing Series A deals. So, I mean, I guess that's the good news. They're down a little bit from same time last year. You can see that the 12 and 22%. But I think what the observation here is that the data from the last quarter really backs up what I think anecdotally either I thought, or you talk to other folks sort of in the community and the ecosystem thought, which is, look, the funds have continued to raise a ton of money. So good funds have been continuing to raise good amounts. There's even been some new funds that have raised some funds. So the dollars are there, but they are being more selective in the deals they do. So when I say funds, that's on the bubble relevant for you. It's relevant for your future. It's probably not necessarily relevant now if you guys are truly at sort of the seed stage that we're talking about tonight. Funds will, and they do have sort of, I won't even say sidecar funds, but almost in something maybe more than marketing dollars, but they will tend to spray that money around. A partner will tend to dump, 100, 250 in a number of deals, not taking a board seat, not looking to really monitor or be super hands-on, but literally just to place a lot of bets. That is not the same thing as when they go lead, $8 million round with maybe a $4 or $5 million check, and they're taking a board seat. But that's how venture, and I'll talk about that in a second, that's how venture VC firms get involved in early stage. It's interesting to have them. It can be good, and of course, these days, any money is money, right? So I think people and founders, are and probably should be maybe a little bit less choosy than they were able to do in the past. And I hate saying that because that's one of my lessons is choose your investors carefully, because there can be a lot of blowback if you choose the wrong ones. But overall, they are people that are participating in seed financings. I'm going to go over the list next of the different players in this ecosystem. So I'll pause there. First-time financing, again, that decreased, right? So as much as I want to continue the story, look, we're in a little bit, and it started at the beginning of this year. It's been a little bit of a downturn, right? And whether this is going to be it, and then we're going to be coming out of it, or whether it's going to get ugly in October, hard to say. My sense is there's still air that's left to come out of here. Maybe because it's been this slow deflation that it's not going to be, at least for us here in the Valley and Bay Area, sort of a big pop. And I've seen a couple big pops. But the interesting thing is the seed stuff tends to be the most resilient. The seed financing, so if you're at this stage raising that money, there is a pause. It does get a little bit harder, but that is definitely the first to come back. And I don't think I've seen it go for more than a year, probably less. And a lot of times founders and clients of mine have said it's almost kind of a blessing, because a lot of the plans they had where they were going to throw money at certain things, they just hunkered down and they just went after, say, customers, and they weren't doing 5 things at once. They're just like, all right, we got the MVP, we got the beta, we got the pilot. All we're going to do is hammer away and just get some beta customers, get somebody who's actually believing in what we're producing. And at the end of the day, had a conversation with a client today. They showed me a deck. We went over it. All sorts of milestones and this, that, and the other, and all sorts of plans. I was just, look, drop everything. There's 3 founders. I was like, just drop everything and just go get on board your customers, your couple of customers, because at the end of the day, you're never going to go wrong with that. Don't plan to raise money to go get customers. If it's anything software, hardware is a different story, right? It takes a lot of money. Maybe you go to Kickstarter or something. But for software deals, for things that lend itself to being able to kind of bolt something together and see if there's an appetite for it, my advice is go out and try to do that, because that, I think, is going to be the big distinction for the rest of this year between the seed companies that get funded and the seed companies that don't. The bootstrap founder funding, very quick slide, but I just say it because that's most likely where the money's coming from. Like, if you haven't raised money, where is it coming from? It's probably coming from your own pockets or the co-founders' pockets. In terms of how much should each contribute, what should each founder get in return. In short, look, some founders may be in a position to fund, some may not, right? Some may be students, PhD over at Stanford, or I've even got undergrad students at Stanford or Berkeley or elsewhere. So it all depends, right? In terms of trying to divvy up that equity pie, for sure. Like, I've seen it can have definitely a bearing on one founder getting more than the other, because money's critical. You may have all the skills you need within your small team. Maybe you got the superstar developer, and maybe you got to go out and hire a UI or UX person or something. But typically, there's a little bit of cash that's needed. It's pretty tough to try to get, and I've seen it, and I'm always impressed when I see it. Maybe a little curious as to the talent of the person involved, but it usually takes cash, right? Even at your startup stage, to go sort of maybe get a little bit extra help, whether you're going offshore for that or somebody onshore. Little less likely that you're going to be able to get that work, that help, for just promises of equity. So look, that can be rewarded. What should the founder get back? Look, I typically just advise a simple promissory note, meaning look, let's not go negotiate with yourself or your co-founders on a convertible note or safe document or something like that, right? This is your company, at least in part. You're funding it, you're getting it up off the ground. But the flip side is, there's no reason, I think, to call it a capital contribution and not really see anything back for that. But what I like to do is I'll just use literally an off-the-shelf, a little form promissory note that I have. You dump in 25 grand or 50 grand, or I've got one founder that put 500,000 of his own money in, but we'll just put a promissory note in place of that. And what that allows is a lot of flexibility. So if you fast forward to your safe financing or your convertible note financing, you, that founder with that promissory note, right, worth 50 grand, can just swap it out for that arm's length negotiated instrument, that convertible note or that safe document. Then you're getting the upside for it. You can also go to sort of the investors that are coming in at the time and say, hey, look, I'm taking the same thing for my same dollars that you're getting for your dollars. So it inspires some confidence and some goodwill. And you don't necessarily get that same thing. Even if you go to sort of these investors that you're pitching over at Phil's or Pete's or whatever, and you say, hey, like I've already dumped 75,000 of my own money. Yeah, okay, they're not going to vet that necessarily or not, and so that may just get lost on them. But it's a different story when you've put the money in, you've parked it in a promissory note, and then you can just say with a straight face, hey, I'm in for 75,000 on this round. Whatever terms we negotiate, I'm putting in 75,000 of my own money. Like that's meaningful, right? That tells them that you're taking your company really serious and you're putting up real money. Same thing happened. It's just the way we paper it up and the way you get to explain it. So sources of investment capital. This is a dense slide. Apologize, but I did want to try to keep it to under 10 slides. Point on friends and family, right? We still call it, and you will hear it called sometimes, friends and family round. That doesn't mean your non-accredited friends and family, meaning that doesn't mean they've got $10,000 to their name, their bank account, and they're going to invest $9,999 in your startup. Like, not a good idea. This is actually one of the places, there aren't a ton of them, with government regulators, but I tend to agree actually with the government regulators. I think it is a good rule. The accredited investors. I'm not necessarily on board. We'll see down below the crowdfunding platform. I'll talk about that a little bit. The democratization of raising money, and I get it. I'm on the bubble, sort of sympathetic with it, but I still feel, having done this for a long, long time, it's tough, right? It's tough to build a startup. It's tough to get the startup and get funding. It's tough once you get funding to keep going. It's exciting as hell, and I've seen some incredible results come from it. But you gotta be sober about it. There's not an insignificant chance you may not make it, and so you go and raise money from your friends and your family, and then on top of that, you go raise money from your friends or your family that are not accredited. And I should back off a little bit on the family. We can kind of get around it. They can make a loan to you if it's your father or mother or somebody like that. We can kind of paper around it because they can just make a loan to you and you can contribute it in. But the friends is tough, or just sort of somebody who's writing a check. I'm doing a deal right now. We're moving them from out of Delaware. I'll just leave it at that because I don't want to give anything away. Into Delaware. A lot of companies end up incorporating Delaware or reincorporating in Delaware. And I'm trying to figure out the cap table to do a conversion and exchange this merger to go move them over into Delaware. And some of the feedback I got was, oh, well, there's two other. I was like, are these the only shareholders? They're like, yeah, well, we have two other shareholders. I'm like, okay, well, what's happening with them? Well, they're fine. They're not coming along. I was like, okay. Like, I guess I got to get a form of share purchase and release agreement of this. I was like, how much did you raise from them? And they were like, $500 and like $800. I'm like what? Like, why in the world would you raise $500 or $800 and go through the trouble? It just baffled me. And these weren't even like, their very best friends or something that they just had to let in for some amount. So also not a good idea. Like, you got to make it worth it. And luckily, I think these people were accredited. It remains to be seen, but I'm pretty sure they're not. If they're not, that's another thing we've done. We have to unwind those deals. There really is, I mean, there are ways under the securities laws to take non-accredited money in, but I can tell you that it's a pain in the ass. There's a lot that comes with it, and there's a lot that will follow you with trying to raise money in that manner. And going all the way back to what I said at the beginning, there's probably a pretty good reason that there are accredited investor rules. Generally, they can't afford it. And it's not cool if you bomb in your startup and they're pinging you, you know, every 2 weeks or every month, like, what's going on, what's going on, what's going on, what's going on? And you're just like, ugh, like, really? And you know, they put in 5K. 5K might be a lot of money, right? They made a choice not to, you know, I don't know, buy a big, you know, 42-inch 4K TV or something like this, and instead they wanted to drop the money into your startup. So it's meaningful to them if they're not accredited, right? If they don't meet those minimum investment tests. So I've spent some time on that, but I do this because it's really one of the biggest mistakes I see companies at your stage. You don't have legal counsel. You pull down a document from YC, right, the SAFE document, and you start blowing that out to people, and then they're not accredited. Make sure they're accredited. Angel money, you know, that's always has been. For as far as I know, I think it will be, even with crowdfunding. All that does is introduce more angels. That's where probably the lion's share of most companies' money, first money in, is going to come from. I get asked all the time, hey, can you introduce me some angels? And the answer is, look, finding an angel, it's very serendipitous, right? They've got somebody individually, even a partner at a venture fund might write a check individually, but that's because they have maybe some deep understanding of the business, and more often than not, particularly in the Bay Area, right, it's somebody that's probably likely either in an operating role or they've blown out, right, of some company, but they feel like they really, really understand a particular space. And there's obviously, I'm sure if we went around and everybody told me about their startups, there'd be a lot of different ideas, right? So it's very difficult to find that sort of one person that would understand your business and say, here you go. There are people that will serially go around and put money in startups, but you know, those folks tend to get inundated as well. And it seems like every year I kind of go through those people in the first quarter, and then they're like, no mas. Like, I got enough for the time being. I got to see how things play out. I got to make sure these companies get funded. And that's the way it goes, right, with individuals. So there are angel groups as well. Plenty of angel groups in the area. Know that it's a longer process. It's a tedious process. There's usually bigger groups, at least this, if not double this, where you have to go and pitch in front of them, and you may win over a third of the crowd, maybe more. You get a couple hecklers, couple naysayers, and I don't mean standing up and throwing crap at you, but you know, they have a meeting or some discussion afterwards. Just takes a couple negative views from somebody out there that other people are like, hey, this is a pretty smart guy, and if he's crapping on the idea, you're out of luck. So it's not an easy path to go. And that's not the best form, in my experience, to try to pitch investors because they will tend to talk themselves out of deals. It's easy to talk yourself out of a deal, harder to talk people into a deal. So bear that in mind. Incubators, accelerators. I looked at this again today to make sure that it was up to date. This seed-db.com accelerators. It's actually a really good list. It's up to date. And I'm going to get these slides afterwards. I'll make sure I share them so you can get some of this information. But it's pretty interesting. Tells you all of the accelerators by number of deals and amount invested. You might tick through that. Think about, hey, you know, could I submit to an accelerator? I know an accelerator I've worked some with, and I used to represent the principal, Ravi Balani at Alchemist, the accelerator, terrific enterprise accelerator, enterprise-focused accelerator. I think they're taking applications for, I don't know, another couple weeks or something. So you have to be mindful of the timing. But they are, I think they are fantastic for the startup ecosystem, not just for the mentorship, which is important, right? You get people coming in that are telling you, all sorts of variety of things that are great things to know, lessons learned, ways to do stuff. I have some clients that are like, I already know all that. I'm too old. I don't need to go an accelerator. And what I would say to that is, there's almost a bigger reason to get inside of an accelerator. The network, if you get into a good one, fantastic. Again, I sort of point out, of course, YC or 500's great, or Alchemist, or IndieBio. I've got clients up there in that space. So it depends on the space, right? You figure it out. But the partnerships, the introductions, the potential customer introductions they can make to you invaluable. And guess what? Best of all, this community of investors that sort of self-identify with that particular accelerator. They're like, hey, we love stuff that comes out of there. So they're already biased towards giving you a very favorable look. And you're not there slogging it out, one after the next, after the next, after the next of these angel meetings. It's not a demo day per se. It's actually almost kind of better than a demo day because you get this longer exposure to these same people. Yes, there is an Alchemist demo day at the end of September or whatever, and there's demo days elsewhere for the other accelerators. Plug and Play, I work a lot with their various accelerators. So those are good, and you can pitch there. But a lot of times it's those longer-term exposure that you can get. I think it's fantastic, and it's a great way to try to get funding early on. So not just the 50,000 check, whatever, from the accelerator, but all the investors that tend to hunt around there. Institutional, the micro seed funds. There are some out here. Interestingly, for whatever reason, maybe I should do my homework, but the micro or sort of seed funds that I've seen mostly in my deals happen to be back east, even though there's a couple of deals back, a couple of companies I have back east that have raised East Coast money, but there's some West Coast clients I have out here that have raised this sort of East Coast micro VC money. Again, there are seed funds out here. For whatever reason, I've seen a lot of them back there. One thing, again, anecdotally, to note between, and specifically, you could say it about venture funds, but it's almost more pronounced, I think, among the micro funds. The folks that I've seen make up the micro funds out here, it's former founder, right? It's somebody who's just had a lot of success and blown out of Facebook or Google or something like that. And then they ultimately seem to morph. If they continue to hit it, they sort of morph into raising their own funds, smaller funds. A lot of the folks that start, the partners that start micro funds, seed funds back east, again, not a rule. I'm just saying observation. They tend to come out of finance a lot, hedge fund guys or Wall Street people. And so they're very focused on numbers, and they're very focused on deal terms. Not that micro seed funds aren't necessarily focused on deal terms out here, but a little bit less so because they're just thinking, hey, I'm swinging for the fence and I just need a way in to this deal, and this is my path. The funds I've seen back east tend to really negotiate a lot harder on a lot of the details that you don't necessarily see negotiated out here. The crowdfunding platform, I'm going to have to speed up. The crowdfunding, I'm probably going to go to 7:30. The crowdfunding platform stuff, I'm just going to skip over that for the most part now. Happy to talk to anybody about that at length. The takeaway should be, I would not be planning on raising your initial seed round on a crowdfunding platform. I think it's great still for rounding out a deal, so you find a good sophisticated investor. You're raising 500, 750,000 or something like that, and you've got somebody that's sophisticated, experienced. You negotiate those deal terms with them. Now you want to round things out on AngelList or Funders Club or whatever. I think that's a great way to do it. I really do. I believe in the platform from that perspective. I'm just a little bit reticent to think like, oh, well, I flogged it around the valley, right? You've got a ton of investors around here, lots of smart people with lots of money, and it's like you couldn't get anybody to bite, so you're going to throw it up on the crowdfunding platform, and hopefully some people from Missouri are going to invest in your deal because it says you're in Palo Alto. I don't know. And I think with that, yeah, maybe you raise the money, but I think with that comes a lot of baggage. Even though they interface and there's funding portals and there's things that have to get done to get to that money, I just think the baggage and the long tail of the hassle of raising that from a lot of people and not having any real smart investors that can actually give you some credible feedback that you're on the right track, You're the long haul. You take somebody else's money, it's the real deal, right? You're on. You can't just blow it off, and they're not going to let you blow it off. So I think you really kind of almost need to go through that gate of a serious investor, really believes in what you're doing. The financing strategy. So, you're going to talk about the round size. That's probably the most defining thing. What I would say about the round size, and this is a conversation I have a lot, people may say, okay, I've done it. I need to raise $1 million total. I need to raise $750. I need to raise $500. And then they say, let's do a safe document. Let's do a convertible note term sheet and stick $1 million at the top, stick $500 at the top. And I'm like, well, okay, well, how much is meaningful that you could actually get going on, right? Like what's going to start to move the needle where you can make real progress. You're not taking a big risk, but you're just moving things along a lot more than you are now. They might say, hey, $100 grand, I can get a lot done. I might say instead of trying, and you got maybe 75 or maybe you got $100,000 sitting around, right, ready to go or close to ready to go. If you go out with $500,000 on the top of your term sheet and you try to get that person who's believes enough and is ready to write a check for $100K, or a couple folks that are ready to write a check for $100K, it's a lot harder time to get them to move off the mark when they're like, okay, well, okay, you're going to have a first close. How much is coming in? You're like 100. Yeah, 100,000. Makes them nervous, right? Because you've said at the top, like you're raising 500,000. They're thinking, well, what the hell? Like, where's the other 400,000 in this deal? Take that same 100,000 and just stick on the top 150, 200K. Like this is the early seed stage round. You explain to them this is just sort of first money in. We're making it a small round. I'm giving really good terms, but I got people around the hoop. Want to close them quick. We're going to tick up from there. Same 100,000 sitting there, but because you've changed $1 million or 500,000 to 100 or 150 or 200,000, they're like, like more than half the rounds filled out. Like I better go, right? I better move. Feel a lot better about writing that same check only because we changed the maximum amount raised. So I'm not talking about playing games. If you really need 500,000 to go anywhere, and if you raise anything less than that, you're dead in the water. Okay, fair enough. Then wait around, and if you get the 500, move on. But a lot of times I've seen that's not the case. Angels, accelerators, micro, venture funds. I already talked about that. So where are you going to raise this money from? How are you going to find them? I think the big takeaway there is, you mine your network. You get out like you're doing tonight, but the best, the premium path would be get into a great accelerator, as far as I can see. That seems to go pretty well. Convertible debts versus safe. The dilution of ownership of founders. I'll touch on that in a second. So the different types of investment, the structure. Straight loan, the only thing I mean by that is that you're not going to do it as a straight loan, right? Other than just to clear up a couple of things that I get asked on. There's the founder loans. I already talked about that. I like to paper that up as a typical straight loan. Swap that out later when you go do your proper outside financing, your safe or your convertible debt financing. You'll hear of venture debt. I'm like, oh, I'm going to go raise venture debt. It's venture venture that likes to give loans. Like, no, venture debt are very particular investors. There's 4 or 5 of them that I can think of that my clients work with, SVB, WTI, Comerica, et cetera. They come in along after you've already raised venture. So they look at the venture funds. They look, and there are some venture debt funds that will literally, like, I only like to invest, in Doug Leone Sequoia deal. Like that's what we look for. That's what we like. So don't think for a second that venture debt's like first money in or something. Convertible debt versus safe. That's really the most likely sort of big fork in the road. It's not even that big of a fork that you're probably going to be faced with. Not looking at that for a second, just trying to summarize it quickly. Convertible debt is sort of the historical bridge or seed financing, right, that we've been using for, I don't know, as long as I've been out here doing it. There's been convertible notes. I can think of doing it back in the late 90s. Safe And so, well, actually, let me explain that a little. So convertible note, it is a loan, right, that you're going to get from an investor. The idea is you're not doing what we would call a priced round, so you're not selling stock. You're not supposedly putting a valuation on the company yet. You're kicking that can down the road because it's early days and you don't want to have that discussion of what my company is worth and what you should get in return for your money in terms of the chunk of ownership of the company. So we do a convertible debt deal, and the idea is you're going to get a convertible note back, a promissory note, but that note, that convertible note, is going to convert when most people would think like the Series A preferred stock financing, so that, you know, somebody on Sand Hill Road or whatever comes in and drops a term sheet on you, and it's that, you know, 5, 6, 7, 8 million bucks, and then that money converts. But it's a placeholder for then, right? So they don't own, they're not a shareholder in your company, they're just there. And you're like, hey, that's a pretty good deal. Big deal points. What's the discount, right, to that round? Meaning you're going to go out and raise your Series A. You need to raise $6 million. You don't want to give up more than a third of the company, so do the math. That's probably a 12 million pre, right? 6 over 12 plus 6, 18, 6 over 18, 33% or so. You got to go out and raise that 12 million at a 12 million pre-money with the convertible debt, with the convertible note. What you're trying to do is give them a discount off of that ultimate valuation. So if it was a $12 million valuation and you gave them a 10% discount, that's $1.2 million less. Or in other words, they're going to get 10% more shares of Series A than the Series A investors that are coming at the time. So that's the way the discount works. And historically speaking, that was it, right? That was the real thing they're getting. It wasn't, you know, 20% usurious interest or something like that. Interest was sort of an afterthought. So that really wasn't what they were supposed to be getting back. You know, interest still is 4% plus or minus, maybe a couple points either way. And the idea was that with this conversion, that's going to be their upside. What happened was then you had investors that got stung, 715. You had investors that got stung in some of these big upticks. And I really started to see what I would call a price cap or a maximum valuation. Like no matter what, like if we, using my example of the $12 million valuation, you got a 10% discount. It's more likely maybe 15, but it's too hard of math for me. So 10% discount, let's use a $10 million valuation. So $9 million, right? So a $9 million, they're going to get 10% extra shares. They're going to feel like a $9 million valuation. The price cap came in with this idea because there were some companies that just blew out really quick. They raised their Series A at a $20 million, a $30 million valuation. Everybody was like, that is kind of unfair. Like, yeah, you got your 10% discount, but it still sucks because you basically used my money to go bootstrap, build this thing, and then just get this jamming, rocking, really high pre-money for your Series A, at which point my money finally converted after a year and a half, and I kind of feel like I've been duped. So people said, oh, okay, let's put in a price cap, like sort of a notwithstanding anything else, no matter what, the valuation will never be more than this. You'll convert at this. Well, that happened, and that used to be this sort of high, like kind of an afterthought. Nobody really worried about it that much. Then all of a sudden investors, note investors, more people started piling into this, you know, investing. More people started getting more sophisticated, more informed about convertible notes, and all of a sudden the whole conversation flipped. And people started giving less of a shit about the discount, and they started just focusing in on the price cap. And all of a sudden, everything we were trying to do early on with convertible notes, which was, I don't want to have the valuation discussion right now. I want to kick that can down the road. I want to keep moving. All of a sudden, this price cap dragged back in this question, what's your company worth? And I have these, again, have lots of startups, so I have these conversations all the time, and it's a way of setting that conversation. My advice to you, if it becomes a conversation only of, you know, what is your company doesn't justify a $8 million price cap. No, of course it doesn't justify an $8 million price cap. The way I like to look at it is, what, if you're planning on doing your Series A, what makes the most likely sense? So in my example, going back to the $12 million example, let's just say you know you need to raise $6 million. Or maybe you're kind of a hardware or something where you just know when it comes time to raise your Series A, you're going to have to raise $6, $7, or $8 million. Well, unlikely you're going to want to give up less than a third of the company because maybe you've already promised a lot through your Series C documents and others, right? You could be dropping below 50% at the closing of your Series A. So you just do the math. Forget what the company justifies. You just start to doing the math, and you're like, like I got to raise. I'm going to have to raise my money. You know, if I was going to do $8 million, right? That'd have to be like a $17, $18 million pre-money. And so you're thinking that, okay, that's the Series A that I've got to target if this thing's going to roll. Well, what's a fair discount off of that? Well, 10%. Okay, you're maybe in the $15 million range. I know. You may be in the $15 million range, but with the price cap, right, they may have you down to like the $3 million or $4 million, right? Huge delta in between. So that's the way to have that conversation. You have to think not necessarily what does the company justify now, but where do you think you're going to be raising your Series A, and then negotiate something fair off of that. And that's really the way I like to try to position the conversation. Safe document, exact same thing basically as a note, except there's no maturity date. So we don't have to worry about the notes coming due in 18 months, and there's no interest accruing. For the most part, otherwise they're the same. Discount, price cap, those are the two meaningful things. The other deal point is the change in control premium. Meaning, what if the company gets sold before I raise my Series A, what do I as the note investor get as kind of a bump? Hopefully not just my money back, right? Because I've been on the ride for a while. I hope to get something more. 125%, 3x maybe. It's up for negotiation. But those same deal points are in both documents. Seed preferred we see. Seed preferred meaning not your Series A venture, preferred stock venture financing. It's kind of like a stripped down, a dumbed down Series A, and the idea is let's make it not so complicated and complex, and let's burn a bunch of legal fees going back and forth. We can dumb this stuff down. We can just get what we call a priced round. Hey, let's get that investor, you the investor, you'll get your ownership stake in the company. We'll still make it a preferred stock, meaning if the company gets sold, there's a liquidation waterfall, like, okay, the investors get paid out first, and then it follows that the common will, again, depending on whether it's participating or non-participating. But the idea is we don't need to negotiate sort of the 50 other deal points that you're going to find if you go onto the nvca.org Series A preferred model form term sheet. Right? There's a lot of stuff in there. We're going to be able to skip a lot of that. We're trying to make it competitive, make it quicker to, say, a convertible note round, but we're going to price it. I tend to see, and I will have a conversation with my client, if they legitimately come out and say, look, I'm targeting, I got people pretty much lined up ready to go to put in $1 million or $1.5 million. I might say, well, maybe we just skip over the convertible debt and go right into Series C preferred. And that's going to depend on the price cap and some other issues as well. So that's the seed preferred. I talked about that. Again, you can find some of this stuff in here. Financing mistakes to avoid. This will be my last slide. The due diligence not being prepared, that's just, you've formed your company on LegalZoom, maybe if you're really informed, Clerky, you've raised your docs, your money off of sort of some safe documents you've pulled down from YC, but it's a mess. In general, you didn't get it right. You need to go through, you need to make sure that stuff's buttoned down before, again, you take money. It's a serious thing. You're taking somebody else's money. You need to come in and make sure that company's cleaned up. And generally, I could, Wilson, and these guys across the street, people, we all go in. We can go clean up a company. It's not hard, but it takes some time. And there's usually, there's a little pain involved if you've really messed it up. And the thing I would tell you is it's so easy. There's so many law firms that do startup work around here that you should be able to get somebody on board around here if your company's worth a crap. You should be able to find a legal counsel, that's going to give you a great deal on setting you up. I do, assuming your company's pretty good. Raising too much convertible debt, that's where it just keeps going. You've raised 500, 750, 800. Next thing you got like $3 or $4 million of convertible debt. You got a bunch of different price caps that are really low. And you're going into your Series A, and if you just do the math on your price caps, you've given up 30% of your company. Good luck, because you're going to hit the Series A. You're going to give up another 30%. You're going to be sitting on 20-something% of your company. Not pretty, not fun. That's the raising convertible debt at too low of a price cap. The unrealistic valuation. expectations. I don't really consider a price cap. I don't really consider that as part of the equation. Certainly, if you go out and you raise, I've seen people again from sort of the outer reaches where they might sell common stock or something like that. Don't sell common stock. Just come talk to me if you ever think about selling common stock. Don't sell common stock. Don't raise money with your common stock. But they go out and raise common stock at a $60 million pre-money or something just crazy. I mean, it's just a mess. You just got to clean that up because it's not realistic. You've taken money, obviously, from somebody who had no clue what's going on, and it literally leads to just a lot of pain down the road. The getting stuck in continual fundraising mode, right? You don't have a huge team of people, right? So you got to wear different hats. And I've definitely seen clients where they're just constantly getting that $25,000, that $50,000 check, and they just constantly seem to be in fundraising mode. You could do that if you've got, hopefully, an engineering founder and a team, maybe that's continuing to crank away, but maybe the guy that's out there, or woman that's out there raising the money, yeah, raising money is important, but maybe also doing some partnerships, some strategic partnerships, or some early sales, or some early customer calls. That's going to ultimately lead to raising a really decent round, and that's ultimately going to lead to the success of your company. So just getting stuck in that constant raising money mode where you're just kind of barely keeping the lights on, that's a tough place to be. You got to be careful. A lot of times you will hit investors. They will ask for sort of all sorts of very obnoxious rights and things that they want. And you're like, I don't care. I just need to get the money in. Well, you know, you may have really screwed the pooch because there are some things that are very hard, very obnoxious, very tough to recover from. So you need to, again, that would just be vetting that stuff with hopefully if you got legal counsel or somebody who's very sophisticated that can kind of, you can bounce that back and forth with. The part about the investors, I mean, sometimes, again, if I'm not hugely wedded to this idea. I mean, money's money. Generally, early on, I wouldn't sweat it too much. But you get to sort of more than kind of that first couple $100,000, people start to look at who your investors are, right? Because there is a certain imprimatur of, you know, legitimacy and intelligence, and, you know, investing early stage, it's an art, right? It's not a science. It's feeling, and people are looking around for a lot of cues to try to see if, okay, is everybody else believing in this thing or not? You can find some people that, you know, have the blinders on and just big believers, but they tend to be really deep in the space, and maybe they just know that this thing's a winner, but that's not very often. The investors, picking your investors wisely, ask them for some references. I mean, I'd be reluctant, you know, if they're not willing to give you any sense for who they are, what they've done. You know, go look up a LinkedIn or AngelList or something. And like I said, don't rely on the crowdfunding portal to raise your first money. So that's it. This slide was just about a typical Series A. Kind of just lingers in there because I send the slides around. The valuation question at the bottom. So I work with a UK-based European. I work with a bunch of accelerators. I go to Europe a lot. I do a lot of inbound stuff. So I do a lot of flips and things. I work with a lot of foreign companies. Good friend of mine at Seed Camp, which is one of the top European accelerators, a guy named Carlos Espinal. He did a great blog on you know, how do early stage companies get valued. And I think it was actually really good. And so you could go to that again. I'll send this around, and you can check that out. That's probably where you should spend your time more than my slide here. That's it. So that was a lot of information. Sorry to go through it so quickly.
So I have a friend who works at PitchBook, and I was able to get like this list of a certain amount of like VCs and angels and whatnot that kind of fit the criteria of what I was looking for. And then I went through AngelList and LinkedIn and found all the references of people to make like warm connections. Mm-hmm. My question is does it make more sense to still submit through the info@vc.com, or does it make sense to have your friend like say, hey, so-and-so just submitted this, look out for it? Or does it make more sense to have them directly send?
You know, a lot of the accelerators are going to direct you So they like you have to go through that because they get a lot of, all their mentors, all the people in the sort of community are saying, look at this, look at that, look at that. They're like, ah. So I would say the better known, more sophisticated accelerators, they're going to force you through that submission process, but they're going to put a reference or referral down there. They should be getting back to you and calling. But of course, if you've got another warm referral to somebody who's a partner there or somebody, I would say you want to run a parallel path and say, hey, can you let them know that I submitted this? Can you say some good things? Just to make sure that you sort of pop out from maybe the crowd.
Okay, cool. Thanks.
Yeah.
Hi. Thanks for your talk. You had mentioned something about encapsulating any investment from the founders in a promissory note. Mm-hmm. Can that be done historically if it's been over the course of, say, a year before you're raising the seed round? Or you?
Yeah, I mean, it depends on your tax returns, right? Have you already got your accountant to book the money a certain way? Has it been capitalized?
If it hasn't been?
If it hasn't been, I don't see any reason why not. Yeah.
I see. And what's your feeling about, in terms of any sweat equity or deferred labor costs?
Nah, I think that's hokey.
I thought so too.
I wouldn't bother. People, investors around here would just be like, no.
Okay, cool.
Like that's why you've got 80% of the company or 90% of the company is because of the work you've put into it.
Helpful.
So
Thank
you can't say, oh, well, I haven't worked or I used to work and my billable rate is X $100 an hour and I times that. No, because that just looks like you're trying to suck money out, which is a big no-no.
Thank you.
Hi. Would you elaborate on corporate seed or venture capital versus the traditional VC seed money?
Sure. So actually, I think if you go, there was a recent, like in the last week or two on the NVCA website that published an article on, I think, Q2 corporate venture for some hard stats. It's corporate venture, and again, I name some of my biggest investor clients are corporate VCs. They used to, and people typically thought of them coming in at sort of like a Series B at the earliest, Series C kind of later stage, and there's always like a strategic deal, commercial deal that went along with the money. And that's still the case a lot of times. A lot of the deals we do, there'll be a commercial component, maybe not necessarily a fully negotiated, partnership or commercial agreement, but maybe a very robust letter of intent or term sheet or something, and a duty of good faith and fair dealing to try to negotiate something down the road. But corporate venture, I think, has continued to sort of come down the financing scale. So meaning, I see them. I've had clients this year. I've had clients that have gotten corporate venture in their seed rounds, which I think just most people would have thought that would have been kind of unheard of a couple of years ago, with a few exceptions. A Cisco or Intel Cap. I worked with Intel Capital for years. I did a lot of their deals back when they were just doing a ton of deals. Now they're doing more strategic. They're back to doing more strategic deals. But I think that the folks they've hired have just gotten more sophisticated, done more deals. So it went from sort of like something else that somebody, out of corp dev was kind of doing or got tasked with, to them deciding, we need to be innovative. We need to follow our peers. A little bit of a herd mentality. Right, because nobody sitting inside corp dev at a Fortune 1000 or Fortune 500 or certainly any tech company that's gone public or has raised a ton of money, they don't want to be left on the sidelines. Well, I think that tech companies have always done that, right? Certainly any company based out here have always done it. But what you've seen is a lot of people piling in, and Foley has a lot of kind of historical, we've been around, I think, for 170 or 80 years. We're like the second oldest firm in the country. So, I mean, Harley Davidson and, Caterpillar and Johnson Controls and lots of retail and clothing. So folks you would never have expected to sort of be involved in any kind of venture at all have set up venture because they're looking around for answers to problems or to innovation, and they're realizing like we can't just keep doing the same thing we've been doing because there's so much competition. So I don't think it's anything that's going to go away. I've read some stuff that said that people sort of forecasted like, corporate ventures piling in again. It's like a sure sign of that the bubble's here and it's about to burst. Because I think people did see it, and I certainly saw it. I remember back in the late 90s, before things finally blew up. You saw it again kind of probably ramp up before the 2008 mess. But my gut here is that this definitely is not going away because I think it's just, it's gotten so networked. Entrepreneurship's blown out. There's so many smart people that are choosing a path like you all, other than maybe just at some, big corporate. Right? So how do they capture these people? How do they capture that talent? It used to be that you would just go into some great opportunity, either consulting or McKinsey or some big corporation and live your life out there. It's just not the case. And people I think coming out of top schools and grad schools, they're not just heading to Wall Street or something anymore, right? They're like jumping into startups and stuff. Well, that's the smart people of tomorrow, right? And how do corporations get a hold of that? They start corporate venture arms, right? Because that's where all the brains are going. So I don't think it's going to go away.
Hi, thanks for your talk. I had a particular question regarding the convertible debt for one of the founders investing. So I read online that it may not be such a good idea to have a cap and a discount rate for a founder note because obviously for signaling, you don't want to signal to the investors that you're diluting the preferred or whatnot. What would be your advice regarding that?
Yeah, I mean, I guess just to be clear, maybe I didn't make my point well. That's my point. That was the point of my talk is founders shouldn't be getting or negotiating with themselves to do a convertible note or SAFE. They should just take back a simple note.
Exactly.
Right? Because you don't want to have this sort of hokey pseudo pretend arm's length conversation with yourself or your other founders on what the deal terms should be. It's just, it's goofy. I don't ever let my clients do that.
Yeah. And probably the goal is to pay back the loan at maturity. I mean, depending on the situation.
Very rarely. I used to see that. I saw it a lot back in early mid-2000s when it was expensive for companies. Right? They had to go hire 10 engineers just to give it a go, just to see if some product even was going to work. And now, you can hack together some MVP and throw it out there and see if you get some interest. So you don't need to raise the kind of money that you needed to raise back in the day. And so back then, because founders would just go here, there, and everywhere to try to cobble enough money together to try to push through to get to a point where there really wasn't that much seed. It was just a Series A because Series A was literally the experimental stage because you needed the money just to go give it a shot to see if it works. Because the ability to figure out whether you got something has gotten so much cheaper. The opportunity I think is for the founders to be able to put in a lot less, and therefore you don't necessarily, your back's not against a wall. I'm not saying that's the case in all. I certainly have founders that are pressed, but it's not sort of that same. Maybe you're not reaching quite as deep into your pocket as say founders of the past. It's certainly not really market, I think, to get money out. Now look, if you get it, you're not going to pull the money out on a Series Seed. You get to your Series A, and you literally personally have dumped, 50 grand, 100 grand, and they're looking at you going, ugh, and you're like, I can't even focus. Like I got a baby at home. My spouse is trying to do their best, but I can't, this is hard. You're going to get a lot of investors who'll be like, all right, you can repay yourself some of the shareholder loan just because they want you focused right? And if they're going to go dump $7 or $8 million into your company, you worrying about whether you can make rent or you've maxed out credit cards or something like that. I've seen a pretty sympathetic year in that case.
All right, thank you.
Do you know do VCs typically use like a standardized term sheet, and then when it comes time to negotiate the terms, do the attorneys typically hash that out, and so the entrepreneur has to retain the services of a attorney group to negotiate those terms, or can you provide some input on that?
Sure. So it depends on what type of money we're talking about. So what stage you're at. If it's a convertible note or safe document, those term sheets tend to get generated by the company. So as diametrically opposed to, say, a Series A, where the term sheet would never come from the company. You're not going to walk around with your Series A term sheet and say, hey, what do you think? What do you think? What do you think? To, up and down Sand Hill Road. It doesn't work like that. But when you're raising a convertible debt round or safe or something like that, it's 90% of the time incumbent upon the company to have the terms, because there's just not many moving pieces. As I said before, discount, price cap, interest rates, kind of a throwaway, change of control premium. Those are kind of the big ones, whether you're safe or a convertible debt deal. So the expectation is you've created that term sheet. Generally, usually with your legal counsel. Again, a lot of times people with safes will skip over the term sheet and just say, here's the safe document. So I want to make that distinction. Yes, when you get to the Series A, what will happen is you'll go around, maybe you guys have watched Silicon Valley. Pretty much the way it works, not plenty that doesn't necessarily work that way, but on the term sheet, yeah, you go around, you will pitch, they'll do diligence, they'll call references, they'll tell you the term sheet's coming, the term sheet's coming, the term sheet's coming, and you're waiting and you're waiting and you're waiting and you're waiting, and then maybe the term sheet comes and you're all excited. It's come like a month later than you thought it was going to come. Yes, at that point, that the VC, my venture clients, will, just because I think they've seen the utility in it, will pass the term sheet by me. Now, they'll have their basic form that they will use over and over, but they'll let me look it over first, make sure it's, there's nothing obvious that should be corrected. I know other VCs. I know a VC that's funded a couple of my deals, and he prides himself on doing his own Series A term sheets. He just knows the stuff backwards and forwards. No problem. Term sheet comes over to the company. You're going to forward it to me, to your legal counsel, and then we're going to walk through it. And then at that point, once you figure out the term sheet, the Series A term sheet, then it's typically on the West Coast, company counsel. I will crank out the first set of documents. On the East Coast, more often than not, I'd say investor counsel will do the first turn of the financing documents. So again, that's Series A though. For everything, all the other money that you're going to raise, it's typically going to be a term sheet that you're going to kick around with your legal counsel. The forms are pretty consolidated, meaning you're not going to see wildly different terms or forms than, like I said, there are a lot of firms around here. 8 or 9 have a really robust startup practices, and those term sheets tend to look pretty similar. And then as a result, the funds that they work with a lot, they tend to pick up those same forms. Yeah.
So I was at a startup, and we got a term sheet for Series A.
Mm-hmm.
And so we thought that was pretty good.
Yeah.
But then instead of the term sheet didn't come, it was the wire transfer never came.
Oof.
So weeks went by, then months went by, and I guess there's a lot of excuses around. We need to get a few more of our key investors lined up, or we like to get a couple of other investors that also want to get in on the round, but the money's going to come, don't worry about it. And so the startup or the company then, turned down a lot of other VC opportunities because they had a term sheet, so they thought they were good. I was just wondering what allows a VC to do that, and how can this be avoided in the future?
Yeah, so I mean, the term sheets are going to be called non-binding, right? And so they're not going to be binding. It's not going to be an absolute legal commitment. But for any reputable VC, I would say, every fund I know that I've worked with, certainly in the Valley and more of the startup hubs, Boston or Austin or, Chicago, even LA or Seattle or whatever, their reputation's everything. To have a VC that would drop a term sheet and then not wire and fund, I don't know many investors, many reputable funds that would ever even consider doing that. So it's surprising to hear that. I'd be very surprised if it was a fund that I had ever heard of that did that. In terms of how do you prevent that, I would go back to one of the slides I said, which is diligence your investors, right? So, I mean, obviously, maybe you want to think about, oh, well, I'll diligence the investor once I get a term sheet. But I think the really sophisticated founders will tend to, I get asked, oh, introduce me to, a bunch of funds. So they're ready. Let's say they're blowing past the Series C. They're ready to raise a proper Series A. My best clients will already know who they want to talk to. And they've even, they've already looked in LinkedIn or somehow they've figured out, or they may ask me like, well, okay, what can you do? I was like, look, I don't have time to go through each one of the websites, all right, of all the investors that could potentially invest in your deal. But you need to be going out. You need to be getting on their site. You need to be looking at the deals that they're in. So first of all, figure out, right, if there's an obvious conflict, whether they've already made a bet in the space. Because there's nothing worse than I do, and that's why I just make sure that my clients have done this homework, that I send over, like, oh, here's the deck of my client, blah, 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 great to catch up with you last week, here you go. And I send it over, and they email me back, like, we got an investment, like, dead on in the space, and it's on our website, like, bonehead, like, didn't you do? So I don't like that, right? These are important relationships for me, as they would be for a lot of people that make their living in this space, in this ecosystem. So you need to do that diligence ahead of time, right? So you diligence, make sure there's a good fit. Part of it's finding, whether they already have investments in the space, but part of it's like just going to their website, like, are they doing real deals? And then doing your best to try to find out more about them. If it's some, investor group, right, which is a lot of times, you have sort of maybe just-in-time investors, you gotta look at that with a pretty scrupulous eye, and maybe they're based somewhere overseas or something like that. That's when things, like, you really got to get dodgy if it just looks too good to be true. Now, if there are other investors that were willing to, possibly write a term, I would be, look, I'm not. It's going to depend. If it's a really good tier one venture investor, and they've dropped a term sheet on you, it should be game on. Like, you should be immediately moving into the deal. Like, if there's some reason that you're not, there's an issue. But I think you can solve a lot of that with diligence. Otherwise, if you get the term sheet, I think a lot of people will continue the process. I don't like to do it sort of behind the back. I don't like to say, oh, thanks, and we're not talking to anybody else, and then at the same time you're shopping it around trying to get 10 other deals. That is going to get smoked out, and you're already pissing on a relationship that's going to be super important for you down the road, and it's bad faith. And I think that's a really bad sign. But I might say, look, I'm already in the process. I've already got several conversations going. I just want to let you know, like, this is great. Thanks for the term sheet. This is super exciting, but I want to finish some things out with some other investors I'm talking to. You could do that. Now, if they come back and say, God damn it, like here, I'll put another X million dollars on the pre-money, like let's go. I want to do this deal. Okay, great. Doesn't hurt you. All right, I've got, so I'm 3 minutes past when I should be out of here, so maybe one more question.
Hello. It's okay. Firstly, sorry for my English because we are a French startup, and my question is we are coming to the Silicon Valley to meet investors to help us forward in our project, but we don't know where we can find these people to explain our project.
So fire up your Pokemon Go app, and there's like an investor creature out there. No, boy, that's a tough one. So I do work. Interestingly, I go to Europe a lot. I work with. I know a lot of people in the European ecosystem. So that's one way, right? So and I know Paris has been a pretty good startup scene going on there. I'm heading in September to Berlin and Frankfurt, putting on a big presentation on flipping to the U.S. and raising money. I go to London a lot. I know our firm has some relationships in France as well. So I'm going to flip it a little bit back on you. One way of meeting people here might be who are your relationships there? Who are you connected with there? Fair enough. If you've just had your head down and there's nobody, you don't know anybody, you haven't raised any money at all in France, and you show up here looking for potential introductions, maybe you want to get a card and we can talk. And I'd have to know a lot more about sort of what you're up to, what you're doing, what your product is, where you're at, and then I could possibly come up with some ideas, and it's going to be something like that, right? It's just going to be you're just at the earliest days. You got to start making some relationships, and then I think you'll find people in general in the Valley pretty good with their time and pretty good with their networking. You could say part of it's part of the culture. The other part is you never know, right? You might be the next big deal company, and so people never want to burn a bridge. But overall, right, it comes out with the right result.
Thank you very much.
So like I said, grab a card, and I would say maybe follow up tomorrow or something. All right.